we had a look here in the PCED services by the 7 major categories. And the reason we did that is because Powell mentioned it. He said that a lot of these components are still troublesome. So let's have a look. Housing and utilities. Hello, everybody. Ed Yard, Denny here. Thank you so much for joining me again for my weekly web chats. And this time, though, I will be going to Chicago on Monday and Tuesday. So this is a recording that I put together on Sunday. So there'll be no Q&A this time around, but we'll make it live next time. Well, there's lots to talk about that's very much live these days. The Fed is very much live. It's hard to really make any decisions in the financial markets without understanding what the Fed is up to. And of course, on Friday, we had Fed Chair Powell's Jackson Hole speech. Everybody waited for it anxiously. And we were thinking that it would sound hawkish, but that there would be something in there suggesting that if inflation can continue to moderate, that the Fed would lower interest rates. After all, that is very much consistent with the FOMC's June summary of economic projections. And in that summary of economic projections, the SEP, it's very clear that the majority of Fed officials are anticipating that the federal funds rate will be lowered in 2024 and 2025 if, in fact, inflation continues to moderate, which is what's in their forecast. So it's kind of interesting to see that the Fed chair veered away from what is the consensus view of the FOMC committee. At least that was the consensus in June. It might have changed since then. It's not too hard to figure out who's on first base, second base, and third base when it comes to all these games that they're playing. They're constantly talking to us and telling us what they're thinking individually. And as we continue to have sort of a mixed bag of commentary, some saying that we have a long way to go to bring inflation down, that they have a long way to go to bring inflation down. Others saying that the federal funds rate may be restrictive enough, and we should just leave it alone and let it do its job. So they're all over the map. But we'll see, I guess, in the next SEP, what is the latest consensus. I can't imagine it's going to be radically different from what they were saying in June. But again, in his speech at Jackson Hole on Friday, the Fed chair, Powell, decided to accentuate the fact that inflation still remains above the Fed's 2% inflation target. He seemed to really want to get a hammer across to all of us that the Fed has absolutely no intention of raising the target rate to 3%. He didn't say that. He just said he was committed to 2%. There have been some economists out there saying that the Fed really should consider 3%, maybe even 4% as their target. But he kind of blew that out of the water and reiterated that the Fed's inflation target is 2%. And that the current inflation rate is above that. He did acknowledge that the last 2 inflation readings, June and July, were good, were welcome, as he said. But he said also that 2 months of good data doesn't necessarily instill confidence that inflation really has been subdued. So he made it clear that there are two choices. Either the Fed funds rate stays here, because the data shows that the economy is slowing and that inflation is moderating, or else if that's not the case, if the economy remains strong and inflation stops moderating, or heaven forbid, actually starts to go up, then the Fed will continue to raise interest rates. So there's always 3 ways things can go in our business, right? Up, down, or sideways. And he made it quite clear that he has no intention of, he's not at this point considering the possibility of actually lowering interest rates. And again, I think that's, he's trying to maintain the Fed's credibility as inflation fighters, and it's pretty clear that the Fed's going to be committed to watching the data. So everything depends on the data, depends on how inflation goes from here, how the economy proceeds from here. But at the same time, he made it clear that he's aware that there are already signs of a slowdown in some areas of the economy, even though we're not seeing that in overall GDP for the third quarter. As you know, it's the latest estimate is the third quarter is coming in around 6%, which is quite a blowaway kind of number. It's also hard to believe that's a sustainable number, and it's not too hard to imagine that it's going to be slowing down. He also made it clear that he does understand that financial conditions have in fact tightened up, and that the Fed has got to watch some of these signs of potential stress in the credit system and how that could impact the economy. Again, I was thinking that with the bond yield climbing back up to 4.25%, rising above that level slightly, now back to basically 4.25%, that the Fed would recognize that if the bond yield kept going up here, that'd be a risk of more stress on the credit system, particularly the banks. The banks, of course, can hold to maturity, so they wouldn't have to necessarily show the losses. But on the other hand, higher mortgage rates, higher lending rates by the banks would certainly create more problems for commercial real estate. And I think as everybody understands that the rolling recession that I've been discussing is now rolling into the commercial real estate market. And that's not necessarily something that the Fed wants to exacerbate, because it's already pretty much baked in the cake, as they say. Well, let's look at some of the charts that we have that we put together based on the speech. In his speech, he made it pretty clear that he's watching quite a few economic variables, and we just thought it would be good to kind of organize them and just to keep track of it. This is sort of a Powell's inflation dashboard, if you will. So let's have a look here. This is he mentioned that the Fed is watching the personal consumption expenditure deflator, but he made it quite clear that he's not that concerned about food and energy. Obviously, those of us who have to drive and have to eat care about energy, but he said it's a very volatile series. These tend to be associated with commodity prices, and his focus is on core PCED, the core personal consumption expenditures deflator. And so if you look at this chart, it's the blue series here is what the focus is on. And we have seen certainly a significant moderation in the core rate, but he's saying pay no attention to that. Let's just focus on the significant moderation in the headline rate, the red line. So pay no attention to that. Let's instead focus on the PCED for core. And that's come down, but it's still quite high at 4.1%. And he's basically saying he'd like to see that heading towards 2%. Doesn't have to get there for him to maybe talk less hawkish, but it has to be moving in that direction. Well, let's see how he's looking at it more closely. In his speech, there were several charts attached to his speech. One of them showed the yearly percent change in the core personal consumption expenditures deflator. And the year over year is 4.1%, as I said just now. And he's also looking at the 3-month percent change. And at an annual rate, that looks pretty good, 3.3%. But put that in the context of him saying that June and July were welcome signs of moderation in inflation, but he wants to see more. So he's not getting too excited about the fact that we're at 3.3%. The personal consumption expenditures deflator also has some components, and the ones that he specifically said he's looking at, he said this in a speech in November of last year. He said that he and other folks at the Fed, I presume, like to look at the 3 major components of the PCED inflation rate: goods, housing services, and non-housing services. And the goods inflation rate's been great. It's come down like a stone. It's down to minus 0.6%. But believe it or not, He even came up with some reason not to get too excited about that, because as I'll show you in a minute, he took out food and energy, and it's pretty impressive in how quickly other goods prices have come down. But he'd like to see it more like what it had been. In other words, more in the negative territory. Housing services, he acknowledged that rent inflation is coming down on new leases, and that the way that inflation is moderated, the way inflation is measured in rents for the PCED and the CPI is a laggard, because it reflects all leases outstanding, not new leases. So he is pretty convinced that the fact that new lease inflation has come down substantially, that we don't have to worry too much about housing services. On the other hand, non-housing services, he's still quite concerned about. And as you can see, non-housing services has been basically stalled at this level of about 4.5% for the past year. And so that's something we'll be watching for. The PCED for July, for July comes out on Thursday. So that'll be an important number. But we already have a pretty good handle on that number, because the CPI for July came out, and obviously a lot of the components are the same, some identical, some not so much, because of weighting and other issues. But let's look at this chart here: personal consumption expenditures deflators for goods, and let's see what's Powell's problem with that. Well, the core goods is what he's looking at, and so that's. Let me just put on my other glasses here. Might be able to see them a little bit better, so get the colors right here. The core goods inflation rate, as you can see, the blue has come down quite a bit, but it's still 1.7%, which sounds okay to me. But he's indicated that he'd like to. That's still above its pre-pandemic level pace, which was actually negative. In other words, core goods and inflation has a deflationary bias to it, and we're not there yet. Durable goods, of course, is doing what it's supposed to be doing. It's deflating, down 0.4%. Maybe Powell can take issue with that, saying it's not deflating enough. Again, he's trying to sound hawkish. He's trying to be hawkish to convince us all that the Fed's on the job still, aiming to bring inflation down. And here's core non-durable goods. As you can see, that's the green line here. I think I got these colors right. Yeah. And so this is down to 4.2%. And so you can see that that's come down. But core non-durable goods is what he has the problem with, that excluding food and energy, we still have a high inflation rate there. The rent inflation story we've shown you before. Others have shown it. It's very well known, and there was a chart in Powell's speech about it, and you can see that the Zillow and the apartment list rent inflations indexes have come down sharply. You can see that the Zillow is down to 3.6%. The apartment list is down to 1.7%. So it's somewhere between there, I guess. And then PCE housing services is the laggard, and it's likely to come down. And so at least Powell conceded that point. Again, he didn't concede anything on the PCED core services excluding housing, as he said. That's been stuck around this 4.5% level. It was 4.1% back here in June, and we'll get July on Thursday. And then the CPI services, X energy and shelter, is not something that he mentioned in his speech at all, but I think it's kind of interesting that basically is the same, conceptually is the same as what we're seeing in the PCED super core, as some people call it. And that's had more volatility. It's spiked much more and come down much more. But again, that doesn't really much matter as long as the Fed's telling us and Powell's telling us what he's looking at, which is the PCED excluding core, excluding housing. We had a look here in the PCED services by the 7 major categories of the PCED services. And the reason we did that is because Powell mentioned it. He said that a lot of these components are still troublesome. These are the components that are going into this measure up here. So let's have a look. Housing and utilities, he acknowledged, is going to come down. So we've got that in here, and it's down to 7% already, and it's probably going to be coming down to something like 3 to 4% in the next 6 to 12 months in a fairly consistent manner. Healthcare has not been a problem. It's 2.2% currently. Transportation services is still a little bit high at 3.6%, but look at what it's come down from, over 15% back here. Recreation services, I guess everybody's paying a lot of money for Taylor Swift concert tickets, but or Elton John, but recreation services 4.7%, so that's still high. He also flagged food services and accommodation 6.5%. Financial services, not so bad, 3.7%, but still high. And then other services, 4.3%. So these are the components of the services PCE that we'll be looking at, and we'll not pay too much attention. We will be looking at, but we'll be expecting that housing and utilities inflation will be moderating, but we'll be expecting that healthcare inflation stays moderate. And then we'd like to see more moderation there. Why do we care about that? Because Powell cares about that. And clearly that's all issues in the on the inflation front. Now, Powell has indicated, and others have indicated, that one of the things about these various industries is that they do rely on labor, and wage inflation has been going up. It's been moderating, but it's still high relative to what the Fed would like to see. So let's go there. This is just shows that the Fed still seems to have a bias towards using the Phillips curve model, basically arguing that higher than kind of trend growth in the economy is inflationary. And I I challenge that idea. I don't think that growth is necessarily inflationary, especially if it's based on productivity. And I think we are seeing some growth here based on productivity, because I'm seeing wages rising faster than prices, and that can only happen. Real wages can only really increase consistently if, in fact, productivity is making a comeback. So I don't really have a problem with the economy growing at a decent pace. I think we can see inflation moderate. Let's skip on that. That's the same concept. Before I get into the wages, let me just cover. Let me see where I'm going. Yeah, let me just cover the labor market and the housing market. Powell said that there was some signs that housing was improving, and he sort of put that in the context of the economy is doing better than everybody thought, and maybe that might require the Fed to be more restrictive because growth is inflationary. On the housing front, we know that mortgage rates have continued to soar, and that mortgage applications are down. So new plus existing home sales are inevitably here going to be still weaker. So this recent rebound in housing, this rolling recession that seemed to be moving into a rolling recovery, forget about the rolling recovery. It looks like the rolling recession will, in fact, continue. Powell was happy to see that the labor force participation rate is increasing. To him, that well, it is an indication that more people are coming into the labor market. If you take the working age population and you multiply it by the labor force participation rate, you get the labor force. And so it is encouraging to see that. He was particularly encouraged to see that the labor force participation of 25 to 54-year-olds has increased, and it's actually above its pre-pandemic level, which is encouraging. He said the participation rate of women 25 to 54 was especially high. So he again, that's good news. He's looking for more labor supply. He'd like to see less labor demand, and so he'll be watching. And he mentioned the job openings, and job openings have come down, but they still remain quite high through June. July's number will be out on Tuesday. We already know from the Jobs Plentiful series, which is through July, and the small business with job openings through July, we know that the job openings remained quite high in July. So from that standpoint, the demand for labor remains quite strong. He did also flag the growth rate in payroll employment. Here's the monthly change in payroll employment. He welcomed the fact that it's slowing down, and it probably will kind of continue to be in this 200,000 or less, maybe 200,000. Let's make it 150,000 to 200,000 range. A lot of that's probably going to be in the industries that we just reviewed in the services area, like recreation, like transportation, and like food and accommodation. On the points of the economy being somewhat slower than suggested by the overall GDP numbers, he flagged the average weekly hours of total private industries and said that they're basically been flat for the past 6 months. And that's true because we've seen this drop in the average work week, but then again, it's probably not going to fall any further. We had this huge increase in the average work week during the pandemic when people who were able to work and remained on the job had to work longer hours because there were a lot of people that didn't remain on the job, that decided not to re-enter the labor force after the lockdowns. But things are normalizing again, which is a good development, but it has offset the increase in payroll employment. And so total hours worked, as you can see, the trend was quite steep here, and now it's been relatively flat over the past few months. So back to wages, here's wage inflation, and he's looking at 3 different measures: average hourly earnings, wage growth tracker, employment cost index. They're all running relatively high at 4.4% to 5.7%. And he didn't mention it in this speech, but in previous discussions, he suggested that 3% would be a comfortable level for wage inflation. So he'd like to see that moderate. And on Friday, when the employment comes out, by the way, that I think I mentioned that this comes out, the JOLTS job openings comes out on Tuesday. And just the very same day, we'll get the Conference Board's number for jobs plentiful. So we'll get that for August. We'll get a more current read on what's going on in the demand for labor. But again, he wants to see this moderate. He wants to see this moderate down to 3%. And we will get average hourly earnings on Friday with the payroll employment data. And we expect it'll continue to moderate, but it's certainly not going to moderate down to 3%. And clearly, like everybody else, we are concerned about these union settlements that are turning out to be quite large. But keep in mind that the private sector unions account for about 11% of overall payroll employment. So they matter, and they can have an impact on other wages to the extent that people look at what other workers are getting, and even if they're not unionized, expect to be getting those kind of increases. But unions aren't what they used to be back in the 1970s, when they accounted for much more of the labor force. And I think it was 16% back then. And also they had cost of living adjustments and so on. Well, Powell also mentioned real interest rates and said, look, real interest rates are positive now. They're not negative. They've gotten up to levels that we think are restrictive, that the Fed thinks are restrictive. And they seem to be higher than most people had expected. The TIPS yield is 1.92%, but he kind of rhetorically asked, how do we really know whether that's restrictive enough? And the only way we're going to know that is by watching all the data that we've discussed so far. But clearly, one of the reasons the bond yield's gone up is because the TIPS yield now at almost 2% is well above where it had been recently, and is kind of getting back to normal. Normal back here prior to the great financial crisis was around 2%. And the inflation premium in the 10-year TIPS has typically been around 2.5%. So that gives you actually 4.5% on the 10-year Treasury bond yield as going back to normal, which is what we may very well be doing. But the suspense is killing me. We're back to 4.25%, which was the high on the nominal rate last year, and finding some support there. We kind of went above it, but we didn't go shooting above it. Powell also mentioned commercial bank loans. We're looking at the data here, and you can see that there is a slowing down to single digits in the pace of year-over-year commercial bank loans, all loans. So we'll be watching that as a sign that financial conditions are tightening. And then he also mentioned industrial production as a, by the way, as another sign that the economy isn't as red hot as some of the indicators suggest. Now, we've said that industrial production weakness is related to the rolling recession in the goods sector. You can see that we had a similar kind of slowdown here in 2014-15. So that was a mid-cycle slowdown. And that, I think, was related to the surge in energy prices that depressed the economy. I'm sorry, it was the other way around. The plunge in energy commodity prices, which depressed the energy sector and had a big impact on the overall industrial production number. There was another slowdown here, sort of, kind of, in the mid-1990s. Nobody got terribly excited about that. But then I think I was the one who came up with the phrase rolling recession back here in the mid-1980s. And you can see we had something like that as well. So again, no Q&A today. No Q&A because this was recorded. I'm up in the air on a flight to Chicago on Monday. I'll be back on Wednesday, but have my laptop with me and have gun will travel, as Paladin used to say, for those of you who remember that show. Have a great week, and we'll see you next week live. Thank you.